Hey, friend, welcome back to the Live Off Rent show, where we bring in real estate and other financial experts to help you build passive income, create your dream lifestyle, reach financial independence, all those things we all want, right? As always, I am your host, Brian Davis, co-founder of Spark Rental. I am on this journey with you in the trenches every month, investing my own personal money alongside all of our members in our investment club. And today I am super pumped to introduce our guest, Victor Menasce. He is a seasoned real estate investor, the founder of Y Street Capital. He authored the book Magnetic Capital: How to Raise All the Money You Need for Any Worthy Venture. And he's the host of the Real Estate Espresso podcast, which, by the way, is an awesome podcast. He squeezes a ton of information into these little 5-minute episodes. So anyway, Victor, welcome to the show.
Oh, great to be here. Thanks for having me.
Well, we usually start by just asking really quickly, how did you get into real estate in the first place?
My path was certainly not the typical career path. I started my career actually as an electrical engineer, designing microprocessors, and
Okay.
worked for a number of both telecom and semiconductor companies, rose through the ranks of both private and public companies, held executive roles, did 5 mergers and acquisitions, 1 IPO. So really got into the whole corporate governance piece. And the year was, I want to say 2008, 2009. I was traveling back and forth to Tokyo every 2 weeks. We were building a new cellular network in Japan for the number 4 carrier in Japan at the time. And it was just punishing on the body. I mean, that 13-hour flight to Narita Airport and the 12-hour time zone change was it just wasn't the right thing for me. So
Brutal.
I decided to resign my position and make a hard left turn in my career, because I saw, much as I loved my career in the tech industry and work with super smart people and was doing groundbreaking stuff each and every day, I saw the opportunity to create wealth in tech as being very limited, in the sense that unless you happen to win the lottery, to use today's example, unless you happen to be a principal at NVIDIA, your chances in the tech industry are pretty limited. It's really like saying, I want to win the lottery when I grow up. So whereas in real estate, I really saw the opportunity. That's where most of the wealth in the world's been created. And guess what? People will loan you money to help you scale your business. And and it wasn't a monopoly or a duopoly or anything like that. It was open to even newcomers to do exceedingly well. And so it just checked all the boxes. And so it was a bit of a hard left turn. And the year was 2009, which you might remember something was going on back then that
Oh, I
made it
remember it
attractive
quite
to enter the
well.
market.
It stung me personally.
Yeah.
It's funny you mentioned, the reasons that gravitated you towards real estate. It reminds me of that Andrew Carnegie quote that 90% of millionaires made their money in real estate. Uh, and the nice thing about real estate as a field is that anyone can make good money in it. You don't need to come from a silver spoon background. You don't need a fancy degree. It's really open to anybody to learn the ropes. It's more of a science than an art. At least I would argue that there is a formula you can follow, that anyone can follow to make money in real estate, and you have a endless possible paths to make money within the real estate field. Uh, so you got into real estate, and then how did you first start investing? How did you scale? What changed over time? Walk us through that journey.
I made a gazillion mistakes.
Me too.
Started from a high executive role in the tech industry, and then somehow convinced myself that I needed to move to the bottom of the industry in real estate, and started flipping houses in Florida, of all things, in Arizona. It made no sense at all. So really ended up in Chicago, ended up wasting a ton of time, partnering with the wrong people, relearned things that I thought I already knew, and it was a very humbling experience. Didn't really lose any money, but didn't make any money either for a few years. And then really got introduced to some folks in Philadelphia who were doing some good quality work. And in the world of real estate investing, it's one of those games that you run out of your own money pretty fast. And I did too. And then I remembered, oh yeah, Victor, you've raised a few $100 million in the tech industry. Maybe you should exercise that skill set. And so I relearned the skill set, discovered it was almost exactly the same, only easier because the fundamentals are the same. But unlike in the tech industry where you're really doing groundbreaking things, where you're not only developing a product, developing a business, you're also developing the market at the same time. You're not doing all of those things simultaneously in real estate. You're doing maybe one of those or two, but you're not redeveloping an entire market. So it's much simpler. And that really unlocked the keys to the kingdom. I met these couple of guys in Philadelphia. They were doing some good work. Said, if you partnered, you wouldn't make so much money on every single deal, but you'd more than make it up on volume. And so we forged a partnership and started essentially acquiring properties in North Philadelphia. Our first deal, we acquired 15 properties for $350,000 in one day at an auction. And that launched us into the business in Philadelphia. And then over the span of the next decade or so, ended up probably acquiring 85, 90 properties, redeveloping most of those into multifamily apartment buildings. And so the process really grew from doing very heavy rehab at the very beginning, because of course it didn't make sense to build new. You could buy things for so much less than construction cost, to eventually doing new infill construction, then getting zoning changes, and then moving from there to greenfield applications, where today, if we fast forward to today, we have several thousand acres of land that we're developing in greenfield opportunities and doing master plan communities and all these other things that you wouldn't do as a rookie project, but progressively over time, as you acquire the skills and as I acquired the skills and our team acquired the skills, we were able to take that on with more and more confidence and take on bigger and bigger projects.
Well, that is actually one of the things I love the most about passive real estate investing is that you yourself as the investor don't need that niche expertise, right? But because you are investing your money with someone who already has that niche expertise. Like in our real estate investment club, our goal is diversification, right? We want to invest in a bunch of different deals, different property types, but we want each sponsor who we're investing with to be really narrow and deep, like in their niche, and to be like total experts within their niche. So we get the benefits of their, super specialized expertise, but we also get to spread our money across a bunch of those different niches and expertises. So I love that, and I love that you guys are so specialized in land development. So we were talking a little bit before we hit the record button about why you love that. So I'd like to dig in a little bit deeper about what it is about land development that you guys love so much and why you see such an opportunity there.
So if I could go back to our mission, it is really to build communities that people feel compelled to call home. And so that could be a land development project, could be an apartment project, could be senior housing project. We have many different things that we're developing within our portfolio. And so it really comes down to, we do townhouse development, we do all kinds of different things. And it sounds diverse, but in many respects, it's very, very similar. The principles are the same. So when we think about any of these projects, it's, first, is it on mission? Are the economic fundamentals in place? Are there more people moving in than leaving? Are there high paying jobs? Is there affordability? All of these things. Is there really robust demand and ability to pay? It's both, not just one. And if those fundamentals are there, then we look deeper and see if there's an opportunity. Now, people often ask me how we hunt for deals. And I have to say, with all honesty and humility, that I have no idea, because we don't actually hunt. We really don't hunt. Every single substantial deal that is in our portfolio has come to us, and we've evaluated it and either embraced it or rejected it, one or the other. So it's really just a matter of finding those, filtering through those opportunities that cross your desk. And many folks might be listening to this wondering, well, I don't have stuff crossing my desk. I don't know what you're talking about. If you're positioned appropriately in the market will find you. So it's really about positioning. It helps that I host a daily show 7 days a week. That's developed a pretty broad and loyal listener base in 139 countries. And that helps. But you don't need that as long as you're well positioned in the market. You could be well positioned locally in your own home market. Maybe take an executive role in your local RIA or anything like that. position yourself in the marketplace so that you become known, become visible, and deals will cross your path.
Yeah, no, it makes total sense. It comes back to networking, right? And building a personal brand around yourself. In some ways, the real estate industry is an old-fashioned industry. It's about who you know and who knows you, right? And that's something that AI can never take away from you, right?
Yep.
Like, as everyone's scrambling to figure out, like, oh my God, am I replaceable? Uh, but to the extent that real estate is an old-fashioned industry that's largely based on networking and your name brand in the industry, it makes total sense, and I love that. One of the things that I love about your podcast is that you dig so deep into market trends and sort of macroeconomic analysis. So I'm curious just to pick your brain a little bit about what you see when you look into the crystal ball, in the immediate future, in the medium future, and then maybe even a little bit longer. What do you see as salient risks or salient trends that we should be aware of as real estate investors?
There's kind of two questions in there. So let me answer the podcast question first. So when I designed the show, it was with a very specific idea in mind. I mean, first of all, why do a podcast at all? Because there's thousands and thousands and hundreds of thousands of them. Why does the world need yet another show? And many of the shows that are out there are the same format. It's a weekly show, 45 minutes to an hour. It's an interview, blah, blah, blah. Why does the world need another one of those? I said, if someone is already subscribing to podcasts and they subscribe to 6 and listen to 5 because that's all they have time for, why would they listen to me? And who am I going to kick out? Am I going to kick out, Bigger Pockets? Am I going to kick out Oprah? Like, who am I going to kick out? So I had to, very, very honest with myself in asking that question. So the thesis was the number one, by doing a daily show, first of all, how many amateurs do daily? Not very
None.
many,
Almost
right?
none, yeah.
Right. So amateurs don't do daily. So that immediately set the show apart from everyone else. And then the second was really respect the listener's time. So the weekday edition are 5 minutes. The weekend edition are 12 to 15 minutes. It's literally your morning shot of espresso when it comes to the world of real estate investing. And I borrowed a page from Seth Godin, very well-known author, marketing genius.
Love Seth Godin.
And he's fabulous. And his daily blog, he has a very simple idea, and that is to get one idea across every day. Not 10, not 5, just one. And if that's for him, if it's half a page, it's half a page. If it's 3 sentences, it's 3 sentences. So just get one idea across every day. That's all I do. That means sometimes going deep and researching. And 5 minutes is a fair bit of content, believe it or not. I do script the shows. It's 850 words that I'm writing every day to research the content. So, for example, I did an episode recently on a Supreme Court ruling on strengthening of property rights. That required research. It required reading the 20-page ruling by Justice Barrett and so on. So it requires research, but then I'm condensing it down and giving it to our listeners in a form that's digestible. And what does it mean? One of the consequences of doing that research on a daily basis, and I say this with complete humility, I often will be reporting on something and then I'll see it appear in the Wall Street Journal 3 to 6 weeks later. And I see that happen routinely. I'm not doing anything particularly magical other than just paying attention. And anyone can do that. Anyone can pay attention. So I'm not doing anything magic, but I am paying attention, and not everybody is. So I think that's perhaps one of the differentiators. To answer the second half of your question, what do I see? I think I see a lot of weakness in the economy that's not being reported. It's not politically advantageous to report on weakness in the economy. So there's all of these reports that, unemployment is low and our consumer is resilient and all of these other bits of nonsense that frankly are not supported by the full breadth of the data. So there's a lot of half-truths being told. And when you correlate the bits of data that are not manipulated and massaged, you can see it very clearly. I'll give you a tiny, tiny example. If there's a unit of economic output, then there is an equivalent unit of energy consumed somewhere in the world. So if the economy is growing, energy consumption is growing. If the economy is shrinking, energy consumption is shrinking. And so when someone says to me, oh, look at how robust the economy is, it's growing, I look at energy and I see what's happening in energy. And are those matching? If someone says GDP is strong, I look at GDI, gross domestic income. Those two should correlate. If they don't correlate, one of those numbers is wrong. And you go on down the list. There's a lot of things that are just simple, easy things to check. And when you unpack that, you maybe uncover more of the truth. Maybe not the whole truth, but at least more of the truth than if you're just relying on the headlines. And that's all I do.
Well, I think there is more risk in the economy than people are really talking about right now. It's funny when you look back at the end of 2022, the head economists for several major investment banks were declaring a 100% risk of recession in 2023. And then of course that didn't happen, right? And then at the end of 2023, the mood among investors seemed to be 0% risk of recession in 2024.
Right.
Both of which don't sound right to me at all. Like it's never 100% risk or 0% risk, right? I mean, there's always some risk, and yes, it fluctuates up and down, but it just seems like investors have priced into the market 0% risk of recession right now, which doesn't quite seem right to me. I mean, so yeah, I mean, to your point that there is undoubtedly some weakness in the economy that maybe we're not talking about. And I'll give you one really quick example that I potentially see. Every week I get on the phone with my dad and we talk for hours about politics and current events and the economy and stuff. And he was talking about how he runs a manufacturing business, and he's talking about how he's afraid to fire anybody in his business because the labor market is so tight. But that is also why the labor market is so tight, right? Because employers are afraid to let anyone go. But that could create a very quick domino effect where the labor market's tight, it's tight, and then all of a sudden it's not tight at all because now employers feel empowered to let their deadwood go and hire better workers, or not, or maybe just let the deadwood go and leave it at that. So those are the kind of things that can change much faster than I think a lot of people realize. And now I'm going on a tangent and a rant, but I want to be respectful of your time here, but one question I'd love to ask syndicators and sponsors is what risks specifically in the real estate market do you think not enough people are talking about? I'll give you, just two really quick examples. 2 years ago, it was interest rate risk, right? 1 year ago, it was probably insurance premium risk. What is it today that not enough people are talking about?
I think interest rates is still high on the list. Cost of capital overall, the fact that there is less liquidity in the market. If I think back to the post 2008 era, interest rates were low. If I think back to some of the very first projects we did in Philadelphia, we got them built and stabilized using bridge financing, construction financing. And then when we tried to get permanent financing, in case of one portfolio projects, it took us 3 runs at it. It took us 9 months. And the terms that we ended up with in the end were maybe 6.5% interest rate, 20-year amortization. And we kind of held our nose at that and said, well, this is not great terms, but we'll take it because we're not getting anything else. So it wasn't just the terms of the loan, it was the availability of a loan. That was probably the number one thing. And the amount of lending that's going to be available going forward, I think, is a real risk. One of my banks just failed this past week. That was Republic Bank out of Philadelphia. They were a lender on several of our projects. They're now part of Fulton Bank out of Lancaster, Pennsylvania. So, when you see one of your lenders disappear, I know Wells Fargo is not going to lend against these construction projects, nor is Chase, nor is BOA. So it's really smaller regional banks that are underwriting the loans on these projects because they have the local knowledge. Even back then, when we were building, again, to use the Philadelphia example, although it's a small part of what we do today, we knew that the major banks were setting policy on a national basis. and that what was happening in North Philadelphia had nothing to do with what was going on in Stockton, California, or in Vegas or anywhere else. And so the local VP in charge of lending at that bank didn't have to worry about any of that other stuff. He could look at what we were proposing, understand our investment thesis, and either made sense to him or not, or her. So it was a much easier conversation because you're talking to someone who has local knowledge. They have the appraiser on speed dial, and they know that the appraiser is going to understand the market and all of these other things. Whereas with a larger institution, you don't have that. I'm very worried about the market as a whole based on what I see coming down the pipe with lending. It's not just interest rates, but I think it's going to be availability of credit under any terms. I think that's the biggest issue.
Well, I agree that not enough investors are talking about some of these debt-related risks. Everyone had just gone into this year assuming that interest rates were going to go down significantly. And already, that that is looking a lot less likely. We might have high interest rates for several years to come. I think that's a real risk that not enough investors are talking about. So anyway, Victor, how can people connect with you if they want to invest with you, if they want to learn more about you? What's the best way for people to connect with you?
Well, the Real Estate Espresso podcast, daily show 7 days a week. It's available on 20 different platforms, Apple, Spotify, tons of different platforms. So love to have you as a listener. Our company is ystreetcapital.com. So the letter Y, streetcapital.com. We have a number of development projects across the United States, stretching from Florida all the way up to Washington State and everything in between. There are some smaller projects. The smallest, I think, is maybe a 12-unit apartment building. The largest is just under 1,800 acres and is a large master plan community and kind of everything in between. So maybe there's something that's a fit for you. We like to think we're institutional quality, and we aim to do that each and every day, always attracting experts to the team. And so I'd love to connect with you there at ystreetcapital.com.
Awesome. Well, Victor, thank you so much for joining us today. This was a lot of fun.
My pleasure. Thank you.
And guys, if you enjoy these conversations that we have, please rate, review the show. It means a world of difference to us. And we will catch you same place, same time next week. Bye now.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have average returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rentals Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.